guys, welcome to Finstock. This is a channel where we talk about businesses. We also talk about online courses. We train you on how we train you on how to run, start, and manage your business. And today we're going to be talking about behavioral finance under trading psychology, and we're going to be defining what is behavioral finance and how does it really affect someone. And we find that when talking about behavioral finance, part of trading psychology is understanding why individuals make irrational decisions in the market or in any other money matters. Behavioral finance, it's a subfield of behavioral economics, and it identifies psychological influences and biases that affect the financial behavior of traders and financial practitioners. And psychological influences and biases can help explain all types of market anomalies, including things like steep prices and falls in security prices. And let's look at the efficient marketing hypothesis. Previously assumed that market participants, they were rational and that markets were efficient. However, you find that behavioral finance presented a challenge to this assumption because it acknowledged that market participants, they may be prone to biases and heuristics, and now with this in turn impact rational decision making. And behavioral finance therefore attempts to understand why people make investment decisions and how do these decisions impact financial markets. So let's look at behavioral biases in investing. So behavioral finances, typically they encompass the concept of behavioral biases, and some of them are following. We have mental accounting. When talking about mental accounting, it refers to the propensity of persons to treat different sums of money differently by allocating it into the mental categories, or what we call buckets, rather than treating all money as interchangeable. So for example, related to loss aversion is the tendency of investors seeking cash to sell winning stock positions over losing stock positions. So we find that when selling the loser may be more rational decision due to the tax loss benefits and the potential that the losing investment may be the weaker investment. So we find that the decision may nevertheless be taken based on the investor's mental categorization over winners as different to losers to a distaste of loss taking. And then you have overconfidence. Overconfidence is the tendency now to overestimate one's own abilities, skills, and knowledge. And many investors, you find that they believe in themselves to be more skilled in investing than the other market participants. It is, however, statistically impossible for most investors to be above average. So you find that overconfident investors, they have the tendency to trade excessively, resulting to high transaction cost and poor performance. And then another thing is hard behavior. You find that hard behavior, and when you're saying hard, you're saying HERD. Hard behavior states the people tend to mimic the financial behavior of the majority of the herd. And the natural human desire to feel like a part of a crowd at times influences investors to follow the investment action of others. And when a crowd is generally going in one direction, an individual may feel uncomfortable or wrong for going the opposite direction. As such, you find that investors may follow the crowd by purchasing assets perceived to be purchased by the crowd, neglecting to do their own research and assuming that the others have done research. So you find that herding is notorious in stock markets, and it's the cause behind dramatic rallies and sell-offs. And then another thing is emotional gap. We find that the emotional gap refers to the decision making based on extreme emotions or emotional strains, and such as anxiety, anger, fear, or excitement. So you find that emotions are often a key reason why people make irrational choices. As mentioned before, we find that fear and greed are notable drivers of human behavior, and this can result in overreactions, giving rise to unfounded optimism, irrational exuberance, and asset bubbles, or conversely market panic and major sell-offs. And then we have anchoring. Anchoring now refers to attaching a financial decision to an arbitrary reference point. So many examples may include spending consistently based on a budget level, and or rationalizing spending based on different satisfaction utilities, where that investors may use irrelevant information such as their purchase price or a security as a reference point or the anchor to their decision making. And they may hold investments which have lost value because they have anchored their estimate of fair value to the original purchase price. So we find that such investors may hold the security in hope of its return to the purchase price without regard to its future prospects or outlook. And then we have self-attribution. When you're defining self-attribution, it refers to a tendency to regard success as a resulting from their own personal abilities, while regarding failures to be the cause of external factors. And self-attribution, usually it stems from an interesting knack in a particular area. Within this category, we find that individuals, they tend to rank their knowledge higher than others, even when it objectively falls short. So as such, you find that an investor may attribute success investment performance to their own superior decision making and skills, but attribute poor performance not to poor decision making. So we have another one called loss aversion, and loss aversion is a common psychological error that occurs when investors place more weight on the concern for losses than the pleasure of market gain. So you find that losses prompt more emotional reactions within the investors than the impact of equivalent amount gain. So in other words, we're saying that they are far more likely to prioritize avoiding losses over making investment gains. So as a result, you find some investors might want a higher payout to compensate for the losses. So if the high payout isn't likely, they may try to avoid losses altogether, even if if the investment risk is acceptable from a rational standpoint. So that is more on that. And if you want to learn more about if you want to learn more about behavioral biases in investment, you can do this at Finstock Evarsity College. Visit their website at www.finstockevarsity.com or call them at 0703313722 or send them an email at info@finstockevarsity.com. Make sure that of this video you like, you comment, subscribe, share, hit on the notification button so that every time I upload a new video, you can always be notified. Until next time, goodbye.